Here from Frankfurt. My name is Andrew Hertel, leader of the fund selection of Scope Analysis. And we talked today about green bonds with BNP Paribas, and therefore a warm welcome to Arnaud-Guilhem Lamy. Hi, Arnaud, to
Hello.
Paris.
Hello, everyone.
Today, we want to talk about green bond, a high-flying theme in the fixed income space. But first of all, Arnaud, please give us a hint about your person, your function at BNP, and what is your responsibility in the green bond team.
Yeah, hello, everyone. So my name is Arnaud-Guilhem Lamy. I work within the global multi-strategy team of the fixed income within BNP Paribas Asset Management. Within this team, I'm responsible for Euro aggregate and for SRI portfolios. I joined the BNP Group in 2007, and since 2010, I've been responsible for the SRI aggregate portfolios within BNP Paribas Asset Management. And since the launch of our Green Bond Fund back in 2017, I've been the lead PM of this strategy.
So you are involved in the idea and the preparation and the launch of the fund to bring us to the market. Is this right?
Yeah, definitely. I've been pushing very hard for the creation of this fund, and with the Sustainability Center, with our SRI analyst, we made the case to our marketing several years ago to create this fund. So yeah, we've been very involved with the Sustainability Center on creating this Green Bond Fund back in 2017.
Okay. Thank you, Arnaud. So then we have the expert on this webinar, and we can talk about different things. Today, we want to talk about, especially about the financial assessment methodology, which Arnaud created, and about the fund, and clearly the performance which was generated over time. We have also implemented, because we have only want to trigger the trigger point and to talk about the important things, we have included a big appendix that the audience can get more information about the team and other things about the fund at the end or after the webinar. So first of all, Arnaud, please give us a hint about what is the green bond all about and how has the market developed over time?
So the first point about a green bond is that it's first and foremost a bond. It's a standard bond, and there's really nothing exotic about it. It's exactly the same type of bonds you could have as a standard bonds. So, and you might have a lot of investors buying green bonds without knowing it, just because they are standard bonds as well. So in terms of credit risk, in terms of liquidity, you have exactly the same type of instruments than the one you can have in the broader fixed income universe. In fact, when there is a green bond which is issued, it will be issued by a corporate or a sovereign or a supranationals, and you will bear exactly the same credit risk than the standard bonds. So your risk is not linked to the project. Your risk is linked to the issuer. So it's not a project bonds per se in terms of credit risk, it's a standard bonds. However, the proceeds of these bonds will be used by the issuer to fund green projects and green projects only. So that's why it's great, I think, for the fixed income investors, because you have the liquidity of a standard bond, the risk of a standard bond, and in addition, you know that the proceeds of the bond will only be used to fund green projects. So that's really interesting from my point of view to have these characteristics to be really the standard bonds with only a green project being funded. In terms of issuers, what's interesting has been the evolution of the market. 9 years ago, it was mainly driven by some supranationals, which have started to issue green bonds. Then we have seen the utilities company issuing green bonds, of course, to fund renewable energy. And then we've seen the sovereign issuing green bonds as well, the banks in order to fund green loans, plus some other sectors like real estate companies, or more recently consumer cyclical companies, etc., etc. And it's really interesting to have seen this broadening of the universe with more and more sectors, and that's what you can see on this slide. That you have more and more sectors being involved, with a share of 20% for financials, so around 20% for non-financial corporates, etc., etc. So it's really much broader than what it used to be something like 5 years ago, and that's why we launched back in 2017 the fund, because we had the start of this diversification and the possibility for the portfolio manager I am to really invest in different markets, and it has been accelerated in the recent years and months, and especially in 2020, with more and more issuers coming in the market, and some different sectors as well coming into the market, especially on the corporate side. And for the sovereigns, we see more and more sovereign issuing green bonds. We've seen recently Italy, but we know we also have Belgium, Ireland, Netherlands, France, Poland, Germany, which have issued green bonds, Chile as well. So we really see this broadening of the market, and that's something very interesting from my point of view.
And it's not only the developed countries who come up with green bonds, it's also on the emerging market side where emissions are come to the market, right?
Yeah, exactly. We see as well more and more issuances coming out of the emerging market. It's around 9% of the benchmark currently, 8 to 9% of the benchmark, and so it's very interesting as well to see that it's not only some developed markets but also emerging markets, because in fact the climate change is global. It's not a local issue; it's a global issue. So it's great to try to fight climate change everywhere across the globe, and not only in Europe or in the US.
So you mentioned you launched the fund. You use an active approach. Why you have decided to manage this out of the active department and not on the passive side?
Well, from our point of view, it's very important to have an active management on green bonds for two reasons. The first one is to be sure that we avoid greenwashing. And that we only invest in green bonds which will have an impact, and that we're able to report on this impact. And if you just replicate an index, you won't have any view on the quality of the green bonds themselves, whether it is green enough or not. And so that's really an issue from our point of view. In green bonds, most of the issuers want to do something good, but some will try to do some greenwashing. Not a lot, but some will try to do some greenwashing, and some other may provide a green bonds which may not be good enough or green enough, or where you might not have an impact report on what they will do. So it's not that the green bond is bad per se, but it's not really enough from our point of view to be sure that we really fund green projects and we know the impact that we will have by funding these projects. So that's why I think we really need an active management on green bonds to be sure that we avoid greenwashing and to be sure that we only invest in bonds which are truly green. The second point, which is important as well, is that, well, the universe is growing fastly, and when you can see the evolution of the index, you will see that there are some jumps in duration, that there are some changes of the benchmark, because this is a young market evolving very quickly, and following the benchmark does not make much sense from our point of view. So that's
Therefore,
really something to have in mind from our point of view. Yeah.
Thank you, Arnaud. Therefore, on slide 4, you bring us in slide in the webinar concerning bonds who are in or out in your universe, and also for the developed and the emerging markets. Can you give us an idea here how you deal with this thing?
Yeah, so in the developed market, we exclude around 20% of the universe. There is no specific threshold, so we would be very happy to exclude 0%. In fact, that would mean that every single green bond is in line with our requirements. However, that's not the case, and so we will see a bit later on the methodology we use. But we have a very strict screening of the green bonds, and it leads currently to this 20% exclusion. Back in 2019, we are at around 25% of exclusion. So we've seen the improvement of the issuers on their standards, but still, it's only 4 out of 5 which are okay from our point of view in developed market. In emerging market, it's even a bit tougher, with an exclusion which is around 1/3.
Yeah.
Because the standards from time to time might be a bit lower, or because you can have some transition bonds more than green bonds. We don't say that transition bonds are not good, but we don't want to have transition bonds in the portfolio. We really want to have green bonds, so no fossil fuel energy, etc., even if it's trying to be more efficient with less CO2 emissions.
You bring us here a slide, and maybe it's a little bit explicable. We talk about the greenium. So you talk, or bring us the idea here, is there a premium in the green bond market? And there are 4 graphs here from different sectors. Maybe you can give us an idea what you have found out, and what is the idea behind this?
Yeah, well, I've said at the beginning as an introduction that a green bond is a standard bond, and the question is, does it have a standard price and a standard yield? And there are a lot of talks in the market on this kind of greenium, whether or not a green bond would have a lower yield than a standard bond. So instead of just talking, I always prefer to show data. And what you have here are 4 graphs from 4 different issuers: a supranational on the top left, a utility company on the top right, a car manufacturer on the bottom left, and a bank on the bottom right. What I wanted to show here are really the yield curve of these companies. In orange, you have the standard bonds. In green dots, you have the green bonds. And what you can see, the only conclusion I would get from that is that there's no rule. There's no rule in greenium. If you look at the supranational, you can see that there is no greenium really on most of the green dots. Maybe 1-2 bips in some green bonds, but not that much. Same thing if you look at the utility company. You may think that the longest green bond is a bit expensive, maybe 1 or 2 basis points, but that's not the case for the belly of the curve. So really, here you see there's no real rule. It's the same thing on the senior preferred bank. You might have the very short-term bonds, which is a bit tight, maybe 2 to 3 bips tighter than it should be, but you don't see a real rule here. On the car manufacturer, it's a bit clearer, where you see 5 to 10 bips of yield give up you have on these green bonds. And what I wanted to show here is what we have seen in the market is that the more green bonds the issuer issue, the less the greenium, the less the difference between the green bond yield and the standard bond yield. And in fact, it's really a matter of scarcity. If you have one green bond issuer with only one issuance in a sector where you don't have that many competitors in the green bond landscape, then there will be a greenium, maybe 10 to 15 bips. But if it is in a sector where you have plenty of competitors on the green bond side, and if the issuer issues something like 3 to 4 green bonds, then this kind of greenium is much smoother, and you cannot really see a clear rule on that. So that's something which is very interesting for investors going into green bonds. Will they give up anything by going into green bonds? Well, as I mentioned, no real specific rule. From time to time can be 1 to 2 bips. Some specific cases 10, 15 bips, but most of the time really no rule. And the more green bonds we see for an issuer, the less rule you have on this.
Okay. So maybe we came up to the fund, and the question is here, and I haven't seen yet. You want to invest in green bonds by a minimum of 83.5% at the total. So what is the current number, and why you use this minimum?
Well, currently in the portfolio, we only have green bonds and cash. So cash is around 5%, and derivatives. So whether it is FX derivatives because we hedge back everything into euro, or futures and options on futures derivatives in order to manage the durations. On the 83.5%, in fact, it was a requirement from a label. The requirement from this label changed to 75%, but we kept the 83.5% because our point in this fund is to provide exposure to green bonds. So we don't want to buy something else. So we kept the 83.5%. It's not really a constraint for me because I will buy green bonds whatsoever for this fund. So yes, the 83.5% is surprising.
Yeah.
It's very precise, but well, it's legacy, I would say. But whatever the minimum, what is in the fund is supposed to be green bonds, derivatives, and cash or money markets.
So this is an aggregate product. Do you have any limits concerning covered bonds or asset-backed securities or corporates, or you are free in what you can select?
No, we don't have limit on the limits on the sectors, and as I mentioned, it's a global warming is global. The climate change is a global issue, and whatever the sectors, we're happy to invest in order to avoid CO2 emissions. So there is no specific limits. However, for the time being, you have very few covered bonds into the portfolio because you don't have that many issuers. You have more and more, and we're very happy to welcome all the covered bond issuers into the green bond market. So we see more and more of those in the portfolio. And in terms of ABS, we don't have any in the portfolio for the time being, but that's just a matter of both the offer and the financial performance we think we can get into it.
So, and concerning high yield, you have a maximum on 20%. You limit it here. What was the maximum in the past you have in high yield?
Yeah, we've never been above 3% in the fund for high yield. It's not because we don't like high yield bonds. It's just a matter of the supply. You have a very few high yield issuers issuing green bonds. Amongst them, some have issued very tiny issuances, and we remain a liquid fund with daily liquidity. So we want to be sure that we have the liquidity into the bonds we buy. And so in terms of supply, it's tiny, so the allocation is tiny into the portfolio. But in the future, if we see more high yield issuers coming into the green bond market, and if they are in line with our requirements, I'd be happy to increase the share of high yield into the fund, if that's a good timing from our point of view to buy high yield bonds. Of course.
Yeah. And concerning hedging, what is originally issued in euro and what is hedged back? How many portion of the portfolio?
Around 60%, 60-70% of the portfolio is initially in euro, the rest being into dollar, Australian dollar, sterling, etc., Canadian dollar, or Swedish krona. But we hedge everything back into euro with FX and forward with spot and forward on FX.
Okay. Concerning duration, Arnaud, you can go deeper and higher in contrast to the benchmark. What was the level in the past? How you managed this?
Yeah,
How far?
Indeed, the leeway is -3 + 2. We went to -2 something to +1, but the +1 was really during a very short period of time. In fact, we don't want to follow the dictatorship of the benchmark. Definitely. So we have this leeway. We use this leeway, and there's something to know about the benchmark duration is that it can move quite a lot depending on some long-term issuance. So when we had back in 2017 the first OAT with a maturity 2039, it added 1 year of duration to the benchmark. When we had the Dutch Treasury issuing a 2040 bond, it added 0.40 year of duration to the benchmark. And so it will be less and less the case in the future because the index has grown, but it's not as big as a global ag index or a Euro ag index. And so from our point of view, it does not make sense to have the duration of the fund to being increased by 30 cents of duration or 40 cents of duration just because one issuance has been added. So that's why really we want to deviate from the benchmark, and we will look much more at the absolute level of duration of the fund versus what we believe is right in the current rate environment. So overall, currently we're around 7 in terms of modified duration, whereas the benchmark is around 8, and that's somewhere where we were quite happy to be with, since we, as I mentioned, we don't want to really stick to the benchmark's duration.
So we see that this is a billion product. You raise money, a lot of money since launch. Where does the money come from?
Well, we have had a very strong interest from private banking, from retail banking and private banking, from wealth management money. So a big part of this AUM has been through the private bank networks within BNP or without BNP, so external private bankers as well. And we have seen as well some institutional, especially some insurers, putting money into the fund in order to show their commitment to green bonds, and because well they needed someone to check the greenness of the bonds which have been purchased.
Okay. So then we can talk about the investment process at all, and therefore, Arnaud, give us an idea how is the process structured before we talk about directly about the green bond selection.
Yeah, so for those of you who already know our product, that won't be a surprise. But so we have a 4-step process combining top-down and bottom-up. And I like to talk about it as describing my week. So on Monday, we have the macro research meeting. So that's the first step of our process. And that's where we will define our fundamental views on the macroeconomic scenario, on monetary policy, where we'll have our forecast in terms of GDP, in terms of inflation, and in terms of expectations towards what the ECB, the Fed, the BOJ, the Bank of England will do in the very near future. So we rely on that, on the input of the macro research team, our internal macro research team, where we have very strong experts within our macro research team. If you have any possibility to have a meeting with them, I really suggest for you to meet them. They're great. In addition to that, we also have some independent macro research from external counterparties that we use, and we pay for it as well. And that's a way to challenge our internal macro research team, plus the experts within the portfolio managers on macro. And altogether, we define our central base case for macroeconomic scenario for GDP and inflation forecast, plus the upside and downside risks.
Yeah.
Then we have the investment committees that we have on the Wednesday once a month, which will use the asset class views of the specialist. So the views from the rates team, the views from the credit team, the views from the EM team, the views from the structured team, etc., etc., etc. And so based on the scenario we all have in mind and the upside and downside risk, then we'll use this asset class views that has been given by the experts on their asset class, and taking all that together with the level of conviction, we'll debate all this, make our own views on the asset class, and use that then as an input for our allocation committee. So the output of the investment committee would be the views of the asset classes with the convictions attached to this view. So positive, negative, very negative with some levels, etc.
Okay.
On every type of views, FX, rates, credit, structured, EM, etc.
Okay.
Then
So,
the third
please.
Then the third step, we have the allocation committee, in which we will use as an input all these views and conviction levels, put that into a construction tool, an allocation tool that we've built internally within BNP PAM that will give us a view of the optimized allocation based on these views. During this committee, we will discuss this allocation, and we may deviate from this optimized allocation which has been given by our quant model. And in addition to that, we will also decide on the credit risk budget, rates budget, and we have a macro risk scorecard where we take into account the cross correlation between the assets, where we take into account the macro environment, the fundamentals, the technical factors, the valuation factors, in order to define the risk budget plus the allocation towards the asset classes. During this allocation committee, we also stress test the market scenario to see whether or not we're still in line with what we want to deliver in terms of performances based on the macroeconomic scenario we defined earlier. And then we have the fourth step, into which we do the portfolio construction, and we will apply this recommendation from our allocation committee towards the Green Bond Fund. And for the Green Bond Fund, we will use a universe which is defined by our sustainability center based on the criteria we'll discuss a bit later on, based on the methodology. So they will define all the green bonds which are in line with our views, and on this specific universe, this green bond universe defined by our sustainability center, we will then apply our allocations and then the decision on the portfolio construction itself.
Yeah. So therefore, we see now the proprietary green bond methodology. Please give us an explanation and how you create this and which influences had over time.
Yeah, so our green bond methodology has been created back in 2015, 2016, and we decided to have two steps, the ex ante step and the ex post assessment. Ex ante is, of course, before the issuance on the primary market, and ex post is when we have had the reporting. So for the first step, there are two filters and an in-depth analysis of the green bond. So the first filter will be on the ESG credentials of the company. So obviously, the green bond is a commitment of the company. The green bond is a promise, and you have to trust this commitment. Yeah. We believe that if the company has very poor ESG credentials, whether it is on the environment, on the social, or on the governance, it's very tough to believe and to trust the company to deliver their commitments. And that's why we've decided to take out the companies which are within the worst 10% of their sectors. So that's where we say the decile 10 is out. So from our ESG score point of view, the companies ranked within the worst 10% of their sectors are excluded. Their ESG credentials are not good enough for us to trust what they will do and to trust the commitments they take on a green bond. Yeah. So that's really why we've dealt with this first filter. The second filter on the ESG credentials is not based on the score itself, but it's based on the ambition of the issuer and the strategy of the issuer. That's something which is very important for us. We've seen some of our competitors being forced to sell back in November some bonds because the company was not really in line with the green bonds they issued because there were some controversies, etc. On our side, we want to be sure that the company strategy is in line with the green bonds they issue. It's great to issue a green bond, but if at the same time you fund something which is a very dirty energy, it's not that great. It's just having a very tiny green bond versus a lot of bad funding of bad projects. So that's also where we have this kind of filter to be sure that the green bond is not just a way to do some marketing for an issuer which would not be green at all. So that's for the first filter that will exclude this green bond from our universe.
Okay. Oops. Sorry.
Yeah. No. Go ahead.
This is the second filter.
Yeah. So. That's the first. So second filter is about the taxonomy. Yeah. So we've defined our own taxonomy back in 2016, and then we have updated it, and we updated it recently as well with the EU taxonomy. So the eligible sectors, we have our renewable energy, energy efficiency, green buildings, clean transportation, waste, water, and natural resources. Here in the slides, you have the social, but the social is only for the social bonds because we also have a methodology for social bonds. Of course, social bonds are not part of this fund. They're great tools, but they're not part of this fund.
Yeah.
Here in the taxonomy, we look at the project, and of course, fossil fuel will be excluded. So fossil energy will be excluded. We've seen some green bonds funding energy efficiency towards fossil fuel or fossil energy. Well, yeah, there might be some good points to make on this, on the CO2 emissions avoided, etc. But we don't think that's something really sustainable on the long term. And it's very tough to be sure that the net impact is really positive. So we have decided to exclude definitely this. The point as well on the taxonomy is that we don't look only at the green bond and the green project itself. We look at the whole supply chain.
Yeah.
What do I mean by that is it's great to go to fund some electric trains, but the question is, how do you produce the electricity? Is it produced through renewable energy or clean energy, or is it produced through fossil energy? And so you have to look at the whole supply chain to look exactly at the potential impact of it. And so some green bonds might be excluded because, well, despite the fact that electric trains are great, if it's funded through if it's the electricity, sorry, it's produced through coal or fossil energy overall, it might make less sense in terms of the impact you will get. So that's why really that's something very specific to us to look at the whole supply chain and not just only the project per se.
And also you implemented an internal taxonomy in contrast to the EU taxonomy to have a stronger approach to evaluate green bonds on this taxonomy thing, right?
Yeah, well, we're very happy to see to have the EU taxonomy as well, and we do the mapping between our internal taxonomy and the EU taxonomy. But first, well, we were first versus the EU taxonomy, so we launched the fund before the EU taxonomy, so we had to have our own taxonomy. There was no real standards at that time, and in addition, if the EU taxonomy is great, it's not covering everything. There are still some sectors not covered by the EU taxonomy, so we still need to have our own taxonomy. In addition, we're very conscious of the no harm condition, and that's something that we look very carefully into the third step of the methodology, which is really looking deep into the project themselves, the way the allocation of the proceeds will be made, what happens if there is no if there is no project eligible right now, how long will it take? How is the money used in this case? And as I mentioned, we really look at this no significant harm principles. That's very important. And we have, for instance, limited the capacity of the hydroelectric project, of the dam project. We have limited that because for some, there are too many bad negative externalities. You know that in this, it's renewable energy, so it's great, but you know that you flood an entire area. And for some projects, which are, from our point of view, a bit too big, it's very tough to be sure that the positive impact are not completely mitigated by the negative impact on the population and on the biodiversity. So that's an example of the way for us to look at this, but that's true for everything.
Arnaud, a question from the audience. What are the two most important questions you ask an issuer before you invest in their green bonds? Or what is a typical question you want to ask?
Well, the first typical question is how does the green bond is involved into the overall strategy of the company? So that's the first question we would have, and the second question would be clearly on the impact of the project themselves, because for the rest of the most of the time we have the data, etc., on the taxonomy, but that would be what are the impacts, positive and negative impacts you expect from this project, and how will you calculate this and report this. That's where it's interesting to have these one-to-one meetings we have with the issuers to go deeper into the analysis of the green bond project.
And therefore, you have evaluate your own screening process, and we find this on the slide with the thing that with the positive, neutral, and negative implementation. How many issuers are out after this implementation?
So it's around 20% of the issuers which are out after this implementation. As I mentioned, on the EM, it's a bit more. It's something like a bit more than 1/3 of the issuers being out, not fulfilling this whole assessment. And so if I don't have a positive or a neutral score for the green bond, I don't buy it into the portfolio. If I don't have a score at all, I don't buy it neither. I always wait for our sustainability center to provide this score before buying. Fortunately, we have a very strong sustainability center, well staffed, and so I have the recommendation on time before primary issuance in order to be able to buy, because that's something very important for us, to buy on primary, because that's where you really lend the money to the issuer, to the corporates or governments. It's great to buy on secondary, but you're not directly lending when you buy on secondary. So we want to be really involved into a primary issuance. It's great as well most of the time from a financial point of view, because in general you have a new issue premium. So that's great, but beyond this kind of financial interest of being involved into primary issuance, it's also important from our point of view to directly lend to the companies.
Two more questions at this stage. What is your attitude to nuclear energy and concerning sustainability electricity? Do you think that green bonds has to finance the expansion of e-grids?
Well, we don't fund nuclear energy through green bonds. So that's not part of our taxonomy. We have no issue with nuclear energy overall. That's not the point. But we don't think that fits really a green bond from our point of view. And on the smart grids, we think that there might be some efficiency gains on this, and that is something which is interesting from our point of view and maybe part of a green bond. The question is how we calculate the impact. Do we really have a report, etc.? And so, well, there might be some debates on this, and some might be in and some
No problem.
out, but that's something which is okay on the part of the taxonomy.
So therefore, we talk about, and on this slide, we talk about reporting and impact. Please explain this strategy and why or how many issuers we has excluded because their impact reporting was not in your sense.
So first, we need the company to commit to provide a report. In this report, we expect to have, of course, the real allocation of the proceeds to the different projects. We need to have the outputs, the number of installed capacity in terms of megawatt per hour for a solar plant, for instance. And we also need to have the impacts. So, for instance, the greenhouse gas emissions avoided in terms of CO2 equivalent, thanks to the project that has been set up. In addition, we want to be sure that this data and information have been validated by an external auditor to be sure that this is all transparent. So we first need the commitment of the company to provide such a report at the beginning. So that's part of the ex ante. And then 12 to 24 months after the issuance, we look at this report. If there is no report, we will reach the company and ask them, well, where is the report? We're still waiting. We're still expecting your report. If it's just a matter of 1 month, 2 months, 3 months, it may happen. It's not that easy. Everyone has to understand that it's not that easy to provide these reports. So we can understand some kind of delays. But if we've been 24 months after the first issuance and we have no impact report, well, there's a big issue here. That's not a delay. That's a problem. And so in this case, if we don't see the report coming in, we will reach with the company, engage with the company, and we have as the example of a company for which we were expecting a report. They committed to provide a report. And after 1 year, we had no report. We came back to them, engaged with them, and said, well, we're still waiting for your report on impact, on the outputs, etc. And they told us, well, that's our CSR report. So corporate and social responsibility report we provide every year. And we said, no, you committed to a specific report dedicated to this green bond with the impact of this green project, not the whole projects you have altogether at the level of the company. We want to see it at the level of the project themselves. And after several talks with the company, it was clear that they would not provide such a report on the specific projects that were funded through the green bonds. So we decided to take them out of our list, and we sold them into our funds. We sold the bonds into our funds. So it doesn't happen that much often. Most of the time, when there is no impact report, we will know it at the beginning, so we won't buy it in primary issuance. But it happened once to have to sell this bond because the company didn't deliver what they committed to.
Okay. So, and this is the thing of transparency, and you want to be full transparency to the investor, and therefore then the company is out. Thanks.
Exactly.
Arnaud, then we come up at the latest point and the important point about the performance. Fixed income markets for the beginning of the year, very difficult, but you reach here an outperformance. Can you give us a hint here?
Yeah, so definitely we had the last years which were good in terms of absolute performance and not that great in terms of relative performance. But beginning of the year is definitely the opposite with the absolute performance which is negative and an outperformance relatively, however, versus benchmark. So what we can see here really is that we've been able through the difficult times for the absolute performance to outperform. That's the case since the beginning of the year. That was the case as well. You can see it on the bottom left in March last year during the crisis. We did far better than the benchmark. But if we go to the next page, you'll see that back into 2019 and 2020, we've been lagging the benchmark at very good absolute performance, but definitely lagging the benchmark. So I think these are definitely some explanations. There are two main explanations for that. For 2019, the main explanation, and that's also the explanation for half of the underperformance in 2020, was driven by the SRI exclusion we have. So the fact that we have a very strict screening process has led us to exclude some US green bonds with very high spreads and very long-term maturities, so very long, very high DTS, the duration time spreads, which performed very, very well in 2019 and 2020, except in March 2020. And that has led these exclusions to most of the underperformance in 2019 and half of the underperformance in 2020. In addition to that, in 2020, our positioning, and a bit also in 2019, in terms of modifier duration, where we don't want to stick to the benchmark duration, and we were, as I mentioned, underweight, mainly between -1 and -2, to stick to a duration that were closer to the rates environment we have, has led to some underperformance as well into the fund versus the benchmark. But that's also what led us to gain since the beginning of the year. And with this profile of what we have had in the past was to underperform a bit in a bullish year for absolute performance, and outperforming in tough years for the absolute performance.
Yeah. So there was a question from the audience: how is high yield? How high is the yield of the portfolio? We see it here with 0.35 and higher than the benchmark. And as you mentioned before, we see that the modified duration is lower than the benchmark. And as you mentioned, we see on the right-hand side that you have 220 securities. How many issuance are in the benchmark?
Well, we're a bit lower than 1,000 issues in the benchmark, around 800, 900 issuances in the benchmark. So definitely, we don't buy the benchmark. We're far from that. Well, we have the selections due to the screening of the green bonds. So as I mentioned, around 20 something percent of exclusion. And in addition to that, of course, we have what we buy from the financial perspective out of that, and around 7% of the portfolio was out of the benchmark back in December 2020. So we can buy as well out of the benchmark. Really, what's driving us in terms of what we buy is the greenness, the quality in terms of green bonds, and our view on the financial performances, much more than the benchmark and the inclusion or not into the benchmark.
And we see it on the right-hand side, also your risk awareness approach, which the value at risk is under the benchmark, and also that we have seen this spread duration and the high average rating. So then, therefore, the question about the rating: all securities are rated from.
Yes, in the portfolio, all securities are rated. We need a B- minimum to be included into the fund. That's in order to avoid the specific situation in the triple Cs, etc., which are really different animals.
Yeah, and as you mentioned before, we see on the left-hand side we have high yield exposure currently 1.6, so it's clearly under the hurdle of 20%. So then maybe we came to the next important point, and to maybe come to an end of this session. You bring us here the green bond impact reporting you produce, and maybe this is explicable by your side, but it has some very good insights about the product. Please, Arnaud.
Yeah, exactly. As I mentioned, we want to be sure that we can report on the impact we have on the project we funded through the green bonds. And so we ask that from the issuers, and we want to deliver that to the investors. Here is an extract of the extra financial report we provide once a year. This was for the year ending in 2019, where you can see the allocation, the investment allocation between transportation, buildings, and energy. And you can see here the breakdown of the avoided emissions by sector. It was mainly, of course, through the energy sector, the power sector, where you had the tons of CO2 of emissions avoided, as you can see here, and also real estate, etc. With the 2020 report, I think you will see something which is much more balanced in terms of avoided emission by sectors. But of course, that's in the that's where in renewable energy that we will find the higher share. This is made by through a partnership we have with Carbon for Finance. Using they use the report coming from the issuers, and they compare that to a benchmark they've created to be sure that it's in line with what could have been the investments and could have been the emissions otherwise. So that's something we're quite happy with, and we will keep on trying to improve. And here in this slide, you can see the what I mentioned with the output. So before we had the impact, here is the output in terms of megawatt per hours of electricity produced through wind, solar, hydro, etc. So the renewable, a specific focus on the renewable energy and all the capacity that has been installed thanks to the projects we funded. And again, for a specific focus on the transportation sector, whether it is thanks to a rail or a clean bus that we've been able to reduce the CO2 emissions, and within buildings, well, is it residential, commercial, or mixed? So that's something which is always evolving. We always want to improve that, and that's something very important for us to be able for you to tell you, well, thanks to the green bond investments you've made into the fund, you've avoided this amount of CO2 emissions.
Thank you, Arnaud. Maybe the last question from my side. As we talked before, in your point of view, what is in success for the fund if we come aware from performance and risk figures?
Well, the first point for success is to be sure that the green bonds were really green, to avoid any kind of controversy, any kind of greenwashing. That's the first point, is to have a very high level of greenness and of impact through the fund. So that's the first point. Second point as well is liquidity. We provide liquidity to our investors. I used to be a portfolio manager in ABS back in 2007 and 2008, so I know what liquidity means. And well, we have a daily liquidity on this fund, and we have to provide that to our investors. So we have to be sure that we have a liquid product. The third point is, of course, about performances, both absolute and relative performances. Till now, absolute performances back in 2019, 2020 have been good, but relative performances have to be improved definitely on our side, and that's part of our success. And the last point comes back to the impact. If we want to have a big impact on the energy transition, to be able to fund a lot of green projects, we have to be sure that we have a huge AUM, huge asset under management, because the bigger we are, the bigger the green bond fund is, the higher the funding to the green projects. So the last point is, of course, in terms of AUM for the fund. So we're beyond 1.1 billion. So we're quite happy with that, but we want to see that growing. We're far from the maximum capacity.
Yeah. Thank you very much, Arnaud, at this stage. So for the audience, maybe I sum up it, and Arnaud mentioned it shortly before, that this is a pure play in green bonds. Important that there is no greenwashing, and I think BNP underlined that they have given in the Article 9 of the SFDR regulation. They have created its own extra financial research, and they have a strong ESG department there. And so we have a 100% green bond completed fund, and the extra exclusion criteria which are mentioned and what comes from the audience. For example, nuclear power is excluded, and any more. And therefore, I thank you again to Arnaud, to Paris. Thank you to the audience. And I hope you stay with us when my colleagues and I will present the next webinar. Tschüss aus Frankfurt.
Tschüss.